And our next guest says the yield curve turning positive for the first time in 2 years is welcome news and will help spur commercial and mortgage loan activity. Joining us is Brent Beardall. He's the president and CEO of WaFd Bank. Steve Liesman is here with us as well. Brent, welcome to you. Listen, please, from someone who's on the front lines, how does this change the outlook? Because I did notice that the banks, they're not down worse than the market today. And I take that as a sign that this is different. You know, in the financial crisis days, not to always go back to that, but you'd see financials down 10% in a 4% market sell-off. Not today.
Yeah, no, it is very different, and they are dramatic shifts that we're witnessing. The great news for banks is this is not credit related. Credit remains incredibly strong. Liquidity is high. Capital is high. And as you just pointed out, what the good news is, even though the Fed has yet to move, you've already got this dramatic shift in terms of long-term rates with the 10-year down, 100 basis points in the last 90 days. And think about what that does for consumers in terms of borrowing on their mortgages, as your last guest just pointed out. Mortgage rates today, 6.25% or so. And I do think that they're going to trend down. What very few people are talking about is the spread on mortgages over 10 years. Traditionally, that's been about 200 basis points. Today, it's about 240 basis points. And I would expect that to come in, which is great news for consumers.
That's what Steve has been waiting to hear.
Been talking about that for a while, but Brent, I don't understand what you're doing here, because isn't your phone ringing off the hook with people wanting to refi their loans today? I mean, if you need to take a call, take a call.
Favor.
What?
No, that's absolutely true. And the great news is banks are open. I've spoken to a few of my colleagues in mid-sized banks, and we are not seeing any deterioration in credit quality. Credit quality is strong, and banks are open for business, and we are ready to lend and help hopefully prevent what looks to be a potential recession.
Let me ask you, though, more seriously about the psychology of a move like this. Do people come in today and say, boom, I got a lower rate today? Or does it cause some people to say, hey, let me wait to see how far this can go?
It's some of both, but it's more people that have been waiting on the fence, and they've been waiting for a pretty dramatic move, and now they've gotten that. You know, houses that weren't affordable before suddenly are more affordable than they were. So I think you'll see a pretty dramatic increase in terms of purchases.
We just spoke with a trio of regional banks maybe last week. The days are so, getting so long now, but they were all sanguine about the economy. We were talking to one in California, one in Houston, one in Pennsylvania, and they did not have any. And okay, maybe it's a small sample size, but I'm hearing your comments as well. And I think if banks are a leading indicator of problems to come, I think you'd be telling me, listen, loan demand is down. There's going to be storm clouds gathering and so forth. Not picking up on that.
No, not at all. We see the economy as strong. We see this as good news for our clients and borrowers. Their cost of financing is going down. And Kelly, you've heard me talk about it before. I believe the fear in commercial real estate is overblown. So many people are talking about this so-called, maturity wall of payments for commercial real estate. Think what this change in rates has done for that. It's made that much more affordable and will soften the blow in commercial real estate.
Brent, I just want to be really clear about what you're saying. You're saying that at the lowest income levels of your borrowers, the lowest credit scores, you have not seen an increase in delinquencies or a worrisome increase?
We have not to this point. Now, we have what I believe is very high credit quality to begin with, but the reality is the consumers are being very proactive in terms of managing their credit.
I want to make a comment, Kelly, and maybe you or Brent want to comment on this. We seem to be going into this, whatever this is, with pretty good balance sheets on the corporate side and on the consumer side. Now, tomorrow we're going to get the consumer delinquency data from the New York Fed, which is going to be very closely followed. But there's always been this question, have we risen back to the pre-pandemic level, or are we going through that level? And we'll be looking for that tomorrow. What Brent is saying is very interesting news in addition to the conversation.
Because the data, Brent, is all over the place. There are some surveys that say delinquencies among certain income cohorts are rising. Walmart has been telling us the consumer is choosier. We have blow-ups like at Helen of Troy or different, companies that are caught wrong-footed by what's going on here. And you sometimes think if it weren't for the AI revolution, the economy and the markets would have retrenched a lot more than they actually have over the past 18 months. So all of us are struggling to describe the kind of cycle that we're in. I don't know how you would describe it.
Yeah, no, it is a unique situation, right? But if you step back and you take the big picture perspective, we just hit an all-time high in terms of the equity markets. And now we're down maybe 10%. That's a correction, and that happens with markets. That's normal. And we already have the markets moving in terms of anticipation of rates, and that will benefit the consumers that we're most worried about.